Hey everybody, and welcome to the last video of Chapter 6. So you may have noticed that I skipped Chapter 6.3, and that's just because Chapter 6.3 and 6.4 really go hand in hand in terms of the important high notes of it. I'm also going to skip Chapter 5, and that's just because behavioral finance is one of my topics of interest, and I frankly don't really like the way that the book teaches it, and so I'd rather not push you guys to learn something that is, slightly flawed or incomplete, and then instead I'm going to give you a couple supplemental videos that you can watch on your own time. And it would absolutely make my day if you guys want to watch those and check those out and then talk with me about these. But today we're going to be talking about efficiency in markets and what that means and whether or not we have it. And so, first, we're going to define what the efficient market hypothesis is and the implications of it. And then we're going to talk about a couple different critiques of the EMH. So, the efficient market hypothesis just says that share prices reflect all information and consistent market edge generation is impossible. So, let's translate what that means. That basically says that a current stock's price reflects what information is available. And so it is impossible to consistently predict stock market movement better than how the market as a whole can predict it. And so that's what we mean as an edge. And there's a couple different forms of the efficient market hypothesis. First is the weak form EMH, and that says that stock prices are reflective of all past data, and there is no technical analysis that are able to get you a market edge. So basically, all data that we have on the current share market price is publicly available and predicted in it. We don't have any information about the fundamentals of the company, but basically every single prior price is a data point, and all those data points lead to what the current price is. So you can't just, run a regression like you see in the TikTok videos and just be like, oh, hey, look, the company's going up and then it's going down, so that means it's going to have to go up again. You can't do that according to the weak efficient market hypothesis. The semi-strong form of efficient market hypothesis says that all information that is public is reflected in a stock's current price, so investors cannot utilize either technical or fundamental analysis to get an edge. And so the way that this differs from the weak form EMH is it includes fundamentals within a company and say that those are also reflected in a stock's current price. So according to the weak market EMH, it would be possible to look at a company's, financial history, read their 10Ks, and derive some future profitability formula that's not necessarily reflected in the current market price. However, according to the semi-strong form EMH, all that fundamental analysis is also encompassed in the stock's current price. And so really digging in and analyzing it also will not get you an edge. And then we finally get to the strong form efficient market hypothesis, which says that all private and public information is completely accounted for in current stock prices, so nothing at all can possibly give an investor an edge. And so the strong form EMH in particular is interesting because it's basically saying that insider trading can also be reflected in the stock's current price. That there are people that know more about the company than others, and even for those people that know more, they still can't get a competitive edge on predicting the market price of the stock. And so that's obviously the strongest form, and which is why it's called the strong form EMH. But the validity of the EMH in any form is questioned by many. And the biggest reason why are several identified what we call pricing anomalies. And these pricing anomalies may allow investors to consistently achieve above average returns. And so we're going to get into what I mean a little bit more in depth in a second. But the bottom line is that the EMH either says that they should not exist or they shouldn't exist for very long. So even with the weak form EMH, if there was a pricing anomaly and people knew how to capitalize on it, they would start trading that company. And as it gets traded heavily by these people doing this fundamental analysis, the stock market price should go up and give data points which reflect this difference between this trading price and what the fundamentals say the price should be, quickly closing that arbitrage gap and then eliminating the edge. So even with the weak form EMH, these pricing anomalies shouldn't exist. The next one is that price changes are actually proven to be predictable using available information. And again, the whole point of the EMH is that we can't predict better than the market. And so the fact that some people can just completely obliterates the EMH. And then finally, and this one's interesting, and we'll talk about that in a bit as well, but changes in stock prices sometimes appear larger than changes in the fundamentals of the stock. So, for example, in an earnings report from Amazon, Amazon may have missed what their projections were by, a quarter of a percentage point. And then we'll see in the market that Apple value or Amazon value goes down by 10% overnight. And, those two, they don't match up. There's way more volatility in the market, and the efficient market hypothesis says that that shouldn't happen. So now we're going to dive deep into those three things. The first one, the pricing anomalies, and this was developed by Fama and friends in the 70s. But pricing anomalies have been picked out by economists that may lead to abnormal returns. And the last that I checked, there's 81 identified pricing anomalies, but it's always changing. And then also sometimes people find out that these anomalies aren't actually anomalies at all. But one of the big ones that you hear about a lot is the small firm effect. And that just says that investment in small firms generally yields a higher return than in large firms. So if you look at the time period from 1970 to 2019, small cap returns usually averaged about 19.6% annually, while large cap firms only return 10.5% annually. So we're talking about a 2% difference in annual returns for these small capitalization companies, these smaller companies compared to the big ones. Then another one that you'll hear reference to a lot is what's called the January effect, which says that the rates of return on certain stocks are really high just during the month of January for some reason. So if you're looking to invest, January is the month to do it because it generally has the highest rates of return, way higher than any other month. And these both don't make sense within the context of the efficient market hypothesis, or so you think. But there are some explanations for at least most of these anomalies within the EMH framework. The big one is data mining. And so it's always possible to retroactively develop a trading strategy with above average returns. You know what they say, hindsight is always 2020. But that doesn't necessarily mean that correlation means a predictable causal relationship. So for example, that the book uses, somebody noticed that in the end of the 20th century, the stock market tended to do much better in years that a football team from the NFC won the Super Bowl than a team from the AFC won the Super Bowl. Now, does that mean that since an NFC team wins the Super Bowl, you should just start investing in the economy? No, Tampa Bay Buccaneers won. I'm not going to start pouring my life savings into the stock market because they won the Super Bowl. It just doesn't make sense. There's just correlation, not causation. And so when data mining occurs, you can sometimes find these weird trends that don't really make any sense. The next one is the risk and liquidity situation. This specifically, it talks about the small cap problem. And basically, the EMH does not necessarily predict equal returns. It just says that it's impossible to outperform the market. And small cap firms may be viewed as riskier and have less publicly available operating information, as well as they're also generally a less liquid investment. You know, a company that has a market cap of $5 million doesn't generate nearly the same amount of demand for its stock than Tesla does. So, with all of these, if you remember back to chapter 4, uh, all of these would indicate that an investor in a small cap firm would require a net higher rate of return. And so that actually would go consistent within the EMH. And so it may not actually be a pricing anomaly in the first place. And then finally, is this weird abstract concept called institutional limits on arbitrage. And those are a lot of big words, but all that this is saying is that, all right, yes, when I'm sitting on my computer and running a regression, some really complicated trading strategies may get me a competitive price edge over the market. But those go away when you actually try and do it, because first off, uh, I don't have the time or resources available to invest in this super complicated trading strategy. Also, every single time you sell a stock, if it gets you a profit, which all these strategies are trying to do, you have to pay capital gains taxes on it. And so if you're selling a ton and generating all these capital gains taxes, you're going to get taxed away a lot of your edge. And finally, there's just limits. You can want to buy, especially, like small cap stock, but if nobody's willing to sell it, you're kind of screwed. And so there's these institutional limits that may limit these pricing anomalies to just theory rather than actual practical implementations of something to get you a competitive advantage. But there are some other critiques. One of the big ones comes from Richard Thaler, which talks about momentum investing. So what we see are stocks going through large periods of growth, and then they get what we call mean reversion. And so the idea is that above average stocks stay above average for an extended period of time and get classified as what are called momentum stocks. So, for example, Tesla recently would probably be considered a momentum stock, even, especially because its operating profit still isn't positive. And so traders, that doesn't mean that you're bad for investing in Tesla. It just means that you're pursuing what's called momentum investing rather than fundamentals investing. But we'll see a bit of a reversion over time, especially in the month of January. That when we look at January and split up companies between the ones that did the best in the previous year and the ones that did the worst, it tends to reverse. So there's this weird momentum investing where people over time start to follow these trends and then they end the trend and then we get mean reversion. And to summarize it all, we can really summarize momentum investing, what Thaler was predicting, 35 years ago, as everybody yelling to the moon. So that's really what momentum investing is all about. And once again, that doesn't fall within the context of the EMH. And then another big one, and this one's a little bit more technical, but it's the excess volatility puzzle. And what it says is that stock returns are 5 times more volatile than pricing models suggest that they should be. So it doesn't matter how risk averse or how costly information is, any reasonable model within the EMH is still way off on how much volatility there is in the market. And this is pictured below in the graph. So this graph, you don't need to know the details, but everything except the red line is a different model that predicts what the market should be at. We're talking about the with companies with real dividends from 1960 to 2019, I believe is when the data ended. But when you graph the two on each other, you can see the red line is moving all over the place, while the green and blue line, especially, while they do move, they don't have nearly the degree of volatility that the red line does, which are the real actual stock prices. And this is a problem because it means that there's some background mechanic going on, not explained by the efficient market hypothesis, that is saying that people are basically, following different investing strategies. And so, for example, if I'm right here, uh, for zero reason at all, I can start investing heavily in the market, and it's just going to go up for like 10 years, despite the fact that any sort of reasonable model predicts pretty slow growth. And this also can't be explained within the EMH. So there are some problems with the EMH. That being said, there are also a lot of solutions to the EMH. And again, the big question is, whether or not we can actually capitalize on these differences. And at the very least, it requires extremely technical analysis and honestly a bit of luck. But with that, you're at the end of chapter 6. You can go ahead and take the chapter 6 quiz now and then get ready for chapter 7.